Good morning, Daniel.
Morning, Dan.
What are we chatting about this week?
Yeah, I want to chat about tax advantaged accounts this week, right? From the time you're born till the time you pass, right? There's all these different types of accounts, and some of them are more appropriate for various stages of your life than others. And I want to talk about all of them, which make the most sense when I'm young, when I'm, in my earning years and peak earning years, and maybe later of life, and how to take advantage of all of them so I can pay the least taxes I can possibly over my lifetime.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay. Well, I mean, that's a whole class that I seem to recall teaching up at CU at one point. So we'll see if we can condense it all down into, 30, 40 minutes and make it a little more bite size.
Let's start with early on in life, right? I think I kind of had this idea when we were talking last episode we did about the 530A slash, Trump accounts. And it's kind of this new account for, younger folks as well. And then I kind of used that and said, okay, well, there's a bunch of different accounts out there, whether it's 529s, you hear a lot of people talk about, oh, can I put money in a Roth for my child, etc. Right. So I guess for early life, how do you go through having these conversations with a client when they say, I don't know what I want to do. I just want to save for their future and make sure they're okay.
It's an interesting question because it's for a third party, right? You're not going to have like a 2-year-old funding their own accounts necessarily, unless they're like the literal Gerber baby. But assuming that they are not an adorable, child model or something, you typically are going to see a situation where this is going to be parents making a decision for their children. And in that particular respect, the primary driver of the decision about which account or accounts we're going to use is going to come back to just the core question of what degree of control do we want and what degree of purpose is there, because we have sort of a range of, as you mentioned, 529 plans, which are specifically for college and education, but you also have UTMAs, uniform transfer to minor accounts, or UGMAs, uniform gift to minor accounts in some states, and those are not purpose suited, but very importantly become children's property. And then you have the 530A accounts now as sort of the first legitimate retirement account for children, if that makes any sort of sense.
Yeah, so I think most people know 529 plans, right? To oversimplify it, it's a tax advantaged account you save into for a child's future education expense. More often than not, that means college or higher education. But, 529s are great, but I hear about UTMAs, UGMAs a lot, and you say it becomes the child's property after a certain period of time. And I know there's some hesitation with folks about that specifically is, oh, when my son or daughter turns 18 or 21, this account now becomes theirs. I guess where do you see people typically utilizing these over 529 plans then?
I don't see a lot of people use these specific accounts for kids. When they do, they're often saying something like, I want to save money for my kid. I just don't want to lock it up for college. And the drawback to almost all of these accounts is sort of the what if, right? I want to save for my kid's college, but what if they don't go to college? Or I want to save money for my kid, but what if they are not a responsible adult when they reach the age of majority, 18, 19, 20, 21, depending on what you've set it up as the age of transfer. Even same concept here around things like doing retirement accounts or gifting strategies. There's always this hesitation on the part of parents, like, well, I want to do something for my kids, but what if fill in the blank, whatever concern there. UTMA, UGMAs are popular for sort of the non-college, I just want to have money set aside for my children type strategies. You also sometimes see these in practice as, because part of this is the idea of completed gifts. So if you're going to have a taxable estate, for example, you might want to kind of speed up and utilize something like a UTMA or UGMA to complete gifts earlier in life, just because otherwise, if we use other strategies, we might have assets still counted in our estate. But what I see in practice rather than UTMAs or UGMAs often is just a brokerage account, in the name of mom and dad. And we just sort of earmark it as, this will be for Timmy someday, but we're going to keep it in our name and we're going to keep control over it. And that way we don't run into the problem of the what if my kid is not responsible or is, getting themselves in trouble or something like that.
Okay, but I assume with the brokerage, right? Like, there's no tax advantage. And do you see a lot of people get hung up on that, or is this one of those like, hey, look, don't let the tax wag like the finance dog, or just what's practical in reality for us here?
Yeah, I think it's something where people let the purpose do the driving here and don't really let the taxes get in the way. You have no special tax rules. You're going to pay capital gains tax. You're going to pay ordinary income on any interest or ordinary dividends that occur. And that's just sort of a cost of doing business. I don't ever see people look at the brokerage and go like, "Oh, but it's not going to have the tax deferral features of the 529. How could I ever do that?" People always look at the purpose first and then find the most appropriate vehicle second.
Or at least they should be.
And in total fairness, some people really, don't know about it, or in certain states, it doesn't make a much of a difference. Like here in Colorado, we have to use the Colorado 529 plan to get the tax advantages, but it does save us 4.4 cents on the dollar. But if you're in a state like Texas with no income tax, it kind of doesn't matter where you do your 529 or if you do a 529 at all because there's no income tax and therefore you don't get a write off for contributing to it. So then you're only using a 529 for the tax deferral ability, and so the degree of value varies, right? Where you have states like California with crazy high income taxes that just ignore 529 contributions and don't give you any benefits for it, which sucks. So again, it just becomes this core question of what is my purpose first, and then is there a tax advantage account for this purpose or not?
I think a lot of the tax advantage accounts earlier in life kind of are geared toward, big things like education. What about just like gifting? It's not really a tax advantage account per se, but do we ever see people just say, "Look, I'll just give them money tax free," and when if and when they do go to college, as opposed to just saving for it outright in a designated account?
Well, and that's where we come back to sort of the individual brokerage or the brokerage account in the name of mom and dad sort of scenarios where we're just going ahead and setting the money aside for ourselves and then we're earmarking it for purpose. You do run into some problems with gifting sometimes. I think a lot of parents, because of the nature of having children, to sort of assume that you can kind of give your kids anything and there's no limitations or issues with that. But you do actually run into some limited case scenarios where sometimes parents are like, oh, I'll just give my kid $100,000 like to help them buy their first house or something. It's like, you just triggered gift tax. So, there are some kind of limited circumstances where you have some exemptions from that. Like you can pay an unlimited amount of college tuition, for example. But if you want your kid to live in like the Ritz Carlton condos or off campus and it's going to cost them, $5,000 a month, you're probably going to end up exceeding gift tax limits on that sort of thing. So you have to be a little bit careful with the larger transfers of this is also where you sometimes run into, gifting from spouse A and spouse B to child, but also child's partner and married couples, or you're trying to break it up over the course of years rather than writing one big check.
I think most of those we just mentioned, like I said, are more education based. I think there's two we haven't talked about that I'd say are more like retirement based. One of which is the one you just mentioned, the 530A. Second, just being like a custodial Roth IRA for a younger child. You want to talk about those a little bit?
I mean, 530A, we talked about a decent bit last time you were on the podcast, so we won't belabor these too much. But, for anybody who missed that one or just wants the quick overview again, it's essentially a traditional IRA for children, except you don't get deductions for your contributions into it, but then the money grows tax deferred. So it creates some cost basis issues and whatnot. It's better than nothing. I'm glad it exists in that respect. On the other side, though, you mentioned custodial Roths, and two things can be true at once. These are probably the best accounts for children and also are probably the place the most people are going to commit quiet, small scale tax fraud. Because the basic rule of any retirement account contribution, other than 530As, is that you need to have earned income. And so, a lot of parents will be like, "Oh, like yeah, my kid earns an allowance." Like that doesn't count. Unless they're in that type of situation, they're probably not going to be eligible for custodial Roth contributions. Like the brokerages don't get themselves into the business of asking you to justify the contributions, but like there's always this wink and a smile thing that people do that kind of I'll say it kind of annoys me as a financial planner. Like they'll come in and say, "I want to open a Roth for my kid." I'll say, "Great." Like, what are they doing? And they say, like, "Oh, like they help me around the office or something." I'll say, "Great." So like we've got them set up on payroll, whatnot. Like, well, no, I'm paying them under the table. I'm like, okay, well, they're going to need to be on payroll. And they're like, oh, okay, sure, sure, Dan, wink. I definitely put them on payroll. And I'm like, I'm not going to ask for it. But just to be clear here, right? If you don't have a W 2 for this kid and their work in the business is not like legitimate and market rate for what they do, so you're not paying them $5,000 to do like 2 hours of filing one day. Right, like you're paying them like 15 bucks an hour to do like janitorial work. So it's just this issue where a lot of parents are trying to transfer money to their kids' benefit, and I love them for it, but it's not legitimate the vast majority of the time that you see it in practice.
Yeah, I think it makes a lot more sense and is actually realistic when, like you said, right, they're 15, 16, 17. Maybe they lifeguard for a summer or something, and they're still living at home and they have a little bit of extra money they wanna tuck away, that's when this actually becomes a huge advantage and something they could take advantage of. But outside of that, more often than not, it's unrealistic. However, you said the 530As, right? We don't need earned income in order to contribute to them. So do you see that as a real way to supercharge retirement savings for some of these younger kiddos that you think will start to see more in practice?
They do, and I think one of the key things that's gonna exist out there as people start, creating these and establishing these is gonna be the early adulthood Roth conversion moment. And this is a complicated area, but very simply, you can take the 530A once they're 18 and convert it into a traditional IRA. You're gonna have cost basis from your contributions. All the interest that has accumulated in it is gonna be tax deferred, so there's some potential taxable income in there. But they turn 18 and you put it in a traditional IRA on Monday and you convert it into a Roth IRA on Tuesday. And now we've got, 50,000, 100,000, however much money, Roth money, compounding and growing from the age of 18. Like that's going to be a valuable and important wealth building tool for parents to use for their kids. The thing that's going to make that complex, A, is you have to deal with the pro rata rule. So that's a little bit messy and kind of a pain. But also, you're going to have an issue where this money is in the kid's name, and I could see that affecting the FAFSA, right? And student age eligibility and different things like that, where you might accidentally bomb your own student aid eligibility simply because you suddenly dump 50 or $100,000 of quote unquote income into this kid's life in freshman year of college, and suddenly all their needs based scholarships or subsidized Stafford loans go away. So you got to be a little bit careful with it. You need to look beyond just the long term tax benefit here, but if you give your kid 50,000, $100,000 of Roth qualified money at the age of 18, that's going to grow probably into north of $1 million, without any additional intervention or contribution over the course of their working years. And that's going to be tax free money. And that's going to make a big difference in their lives, full stop.
Yeah. So you mentioned the working years, which I think is a nice transition there. I think this is when we start to get into a lot more retirement accounts and things where you can just really shovel a lot of money in for yourself in the long term. I think there's, the basic ones we all know of, right? Things like the 401ks, maybe some defined benefit plans, and if you're self-employed, maybe things like a solo 401k. Um, is there anything I don't know if we have to spend a lot of time talking about these specifically, but would you see these as really just like the first priority when somebody comes to us and says, "Hey, I'm working and I'd like to start saving. How should I go about doing that?"
Yeah, I mean, we're gonna default to your 401k or your cousin plan, which is not an official term, but these are 403bs, 457s, any plan that's got a today $24,500 contribution limit for people under the age of 50, and that likely has some amount of employer matching. That's always going to be where we recommend starting. The only reason we wouldn't recommend starting is either A, if we have some shorter term goals that are going to need liquidity outside of a retirement plan, or B, and this is rarer, but it does happen, you are employed by an employer who doesn't offer any sort of match. Then we have to weigh the value of the tax advantaged or tax deferred contributions or the Roth contributions and just how much money we can put into this tax advantage category against the potential operating costs or fees being incurred by these plans. Some of these plans can have what are objectively sort of high fees and costs that are still worth incurring because you're getting this dollar for dollar match or this 50 cents on the dollar match to your contribution, where it's like, yeah, the plan is like 2% a year, and that's really high in fees. But if I put in a dollar and my employer puts in a dollar, great. We pay them 4 cents, and I still am a dollar 96 richer for having contributed. So that's the only kind of hesitation. But to your core question here, if somebody comes to me and just says, "Hey Dan, I make decent money. I want to save and invest. Where should I do it?" My first answer by default is going to be in your 401k or your pension plan if it's available.
Alright, and you kind of alluded to it, but what about after that? They say, "Hey, I have a match in my 401k, but I do have excess money that I'm now willing to contribute. Should I put it into my 401k? Should I put it into an IRA? Should I maybe use an HSA or an FSA?" I guess how do you after the match start to weigh the pros and cons of different investment vehicles there?
Herein, we sort of get into like a default versus excess. So, question: should I fund my 401k or should I put my money somewhere else? So long as there's a match, we want to at least fund up to the match because there's free money as part of our compensation package. We should just be doing this pretty much by default. Outside of that, when we look at getting out of the 401k and into either unmatched dollars in the 401k or elsewhere, now we start to look at it more through the lens of goals and objectives. Hey, do we own our house? Are we saving for a house? Are our student loans paid off? Do we have our credit cards paid off? Do we have an emergency fund? So all those are going to kind of play into it. I think first objective here is going to be, let's go ahead and get the emergency fund built. With the emergency fund, we're not really looking for tax advantages, but we're trying to get into a money market or a high yield savings. We're trying to at least get inflation out of that. Rules of thumb there, we want to have 3 months of expenses as a baseline. Up to 6 months would be great. And then once you get through that category, now we start looking a little bit further out at things like, as you mentioned, FSAs or HSAs for healthcare, dependent care, or we might even be getting into the land of, hey, my 401k isn't that good. I'll contribute up to the match, but my next retirement dollar I want to put into a Roth IRA or something like that instead of my employer plan. So those are going to be some kind of shorter term, smaller dollar detours along the continuum of your total kind of wealth accumulation and savings.
I mean, that makes sense. I think the one that I'm getting hung up on there is like, when do you recommend either an HSA or an FSA over, say, like a Roth IRA or additional 401k savings? Because I think there's a decent amount of people who will use an HSA, not with the intention of using it in the current year, but more as a long term accumulation vehicle. And if that's their intention, I guess, how would you have a discussion around using that versus excess savings into your 401 or starting to utilize something like an IRA?
Yeah, I mean, HSA is going to be the best money in the tax code, right? Tax free and tax deductible going in, tax free coming out as long as it's spent on a qualified thing. I'm a little cautious about overloading them. Like, and I say this as a person who maxes out his HSA every year, but I'm a little cautious about overloading them because I think there's a world where you can contribute so much that you'll never spend that money effectively. And in that scenario, you have a release valve. You can do a conversion from an HSA into an IRA, or you can get past the minimum distribution age for the HSA and then just sort of be able to spend it like it's an IRA. Like, there's some exit strategies there, but I'm hesitant to recommend it as a first stop, particularly just because, again, even though it has the best tax treatment, it's really selective in its use. So if you say like, oh, Dan, should I fund an HSA or a Roth? All things being equal, I'm probably going to favor a Roth over an HSA. But I also look at, fair life circumstances. If you are a person who is diabetic or you have glasses or you are a woman who has regular prescriptions like birth control, like there's various things like that are just going to make an HSA a default contribution vehicle, even if it's just to cover the regular recurring expenses. To your question about then like kind of the wealth accumulation strategy, an HSA has a generally lower limit as an individual or as a family than Roths are going to have. It's going to, again, have more persnickety rules around the utilization. So it's a good option, but I think you go 401k and then Roth and then HSA if you're just trying to set up a default order here.
Okay. I think that's a pretty good framework there. Just out of curiosity, you say some people might end up accumulating so much in an HSA they don't end up utilizing its full balance. I know you're hesitant with some rules of thumb, but what do you think is too much in an HSA?
I mean, you have to look at just what your out of pocket limits and deductibles are and say, like, okay, I'd like to have enough to cover that. But the question here is, let's say my family out of pocket maximum is $15,000. Okay. Do I think I'm going to hit this every single year? Probably not. Do I think I'm going to hit this every year long term? Probably not. Is there a world where I could have maybe like some serious medical issues for 2 or 3 years back to back? Maybe have like a long running cancer treatment or something like that where we're hitting the cap every year. Sure. I think when you get kind of like north of 100,000 in HSA, we're probably well funded enough. Unless money's coming out of it immediately, even if it's growing at a money market 4% or something like that, we're getting to the point here where unless we go through multi-year protracted high expenses, we probably don't need to keep funding this thing unless we're just trying to shelter income for tax purposes. And then sure, I think that also circles around to the default order I just gave, which is I think if you're in the 32, 35, 37% tax brackets, it could make a little more sense to go into the HSA than the Roth. But again, I think that calculus is a bit squishy.
Neat. I think one thing we haven't talked about on the Roth is a niche thing that's usually specific to a plan, but it's the mega backdoor Roth. Where do you see this kind of falling in the sequence of prioritization for savings?
Well, I think first and foremost, we have to just think about who this is appropriate for audience wise. The mega backdoor Roth is different than a backdoor Roth. So backdoor Roth is putting money in a Roth IRA when you earn too much, meaning you're earning about 140, 150,000 as an individual, or about 240, 250,000 as a married couple. That's where you do backdoor Roth contributions because you can't make direct Roth contributions. That's relatively straightforward. Mega backdoor is going to kick in when we are just starting to look for places to dump money. So we're looking at a household probably with an income, north of 250, 300,000. So same issue for backdoor Roth, but also, our mortgage is costing us less than 10% of our income. Our bills are paid. We have no short-term consumer debt. Our student loans are either on track for forgiveness or they're paid off. We funded the kids' 529 plans and the 538 plans. Like we've really tapped into most of our shelters, and now we're kind of getting to the end of the line. All this to then say you need to work at an employer with a 401k plan that offers a mega backdoor feature. You are not going to find this in small plans. So if you work for a small business, like here are my wealth planners, we don't have mega backdoor Roth accessibility through our plan. So woe is us. But if you work for a big company like Amazon or Apple or Microsoft, or just a big employer, then you might have the option to do this. And essentially, you're putting in after tax contributions in excess of the employee limit, and then you're converting them into Roth dollars pretty much the next day. And some big plans will let you even automate this. Other plans are a lot more restrictive around whether you can do it at all, or if you can do it, what features are there to support the ease of doing business for it. But it gives you the opportunity to put north of 24,000 or north of the low 30s into your plan, where you can get your total contributions up to 40, 45, 50,000, and that's a pretty good place to end up on. At the end of the day, there's still some contribution limits that are the accumulation of your employee contributions and your employer match. So, the higher your income, the more you're able to put in total, but the match also might be filling up more of the space for you. But all this gets you to a world where if you can really max it out all the way, you might be able to get $60,000, $70,000 into a plan and then enjoy the tax advantages thereof.
All right, so it's almost just like having a Roth feature within your 401k that allows you to just put more money into the 401k.
Well, a raw feature, but specifically it's more about the increased limit because you've got that $24,500 limit for an individual, and this is letting you get up to 30, 40, 50 in your own contributions. So that's the primary feature. It's a funny thing because to have the income where this makes sense for you economically, you're probably in high tax brackets where frankly you'd probably like to be able to do it pre-tax if you could, but you can't.
All right. So it's better. I'd say from a tax perspective, it's better than like I'm trying to think of where I would use this instead of just doing some sort of HSA or FSA at that point. I think would you recommend utilizing that before a mega backdoor Roth, just so you at least have some money in one of those two if you have the option?
I would also just because again the HSA is going to be back to the who the mega backdoor is appropriate for, right? Mega backdoor, I'm probably in the 32% bracket, or I'm close to the 32 bracket, or I'm well above it. And in that scenario, I kind of want the tax write off from an HSA before I want Roth money. So that's something where, again, if for an audience appropriateness, you probably want to fund an HSA or an FSA prior to that, assuming you either have an ongoing healthcare need or dependent care need where it makes sense on the FSA side, or that you are not so over accumulated on the HSA side that it stops being useful.
Got it. All right. And anything else in the peak earning years you think is worth prioritizing or discussing here?
I mean, I think if you're a business owner, there's a whole subgenre here of like what plan do you pick for yourself, or if you're self-employed, what plan do you pick for yourself, and then deferred comp plans for our high earning executive types. So I'll let you kick one of those off if you'd like.
Yeah, let's do the deferred comp plans. I feel like I don't see them too often, but every time I do it, I think they're pretty cool. Is that more of just like a bonus, I think, than really a necessity in terms of savings for folks? I think it's also something that typically gets seen as like an incentive for some of the higher earners. So they're probably already doing some of, if not all, the things we've already discussed. I guess where does this land in terms of priorities for you?
Yeah, I mean, essentially, one day in the future, when you earn so much money that you've maxed out your 401k and you've maxed out your HSA and you've maxed out the mega backdoor features and you funded your kids' 529 plans, you've done it all, and you still just have more money than you know what to do with. Then companies can offer deferred comp plans, and a deferred comp plan essentially is a discriminatory, and I mean that in the sense that the company can limit who participates in it and so on, but it's a discriminatory plan that allows the company to essentially just let employees say, you know what, I'd like to not have as much income as I have. So I'm a software engineer for a big AI company or something, and I'm making $600,000 a year. and I really only need 300,000 to live on, so I'm just trying to make the other 300,000 disappear so I don't have to pay so much in taxes. In that type of scenario, deferred comp is helpful. There is no free lunch. I think something that sort of trips people up is that deferred comp plans often look, and when I say look, I mean this in like when you see it on your computer screen sense. They often look like a 401k plan, but we need to be very cognizant that deferred comp plans and the mechanism that makes them work in a tax code sense is that there's a substantial risk of forfeiture, meaning there is a risk that you could lose your deferred comp because the company goes out of business or is sued or something like that. So that's the risk you take on with deferred comp, where simultaneously they're enormously powerful tax planning tools because you can just dump money into them without limitation, essentially. On the other hand, unlike your 401k, which has unlimited creditor and bankruptcy protection, your deferred comp is as at risk as your company is as at risk of going out of business or otherwise, being sued and having a large settlement or judgment take a lot of money out of its coffers.
Alright, so you're essentially just putting faith in the company. So if it's a small company that's offering you a deferred comp plan, there's a lot of risk there. But if it's maybe, I don't know, Amazon, right? You probably have a little bit more faith in your ability to actually obtain that benefit in the future.
Yeah, I mean, you can have high confidence, but here's the trick, right? We're thinking about long-term life cycles here, where maybe I'm a 50-year-old executive at one of these big companies, and I'm like, "Hey, it's good, it's healthy, it's great." And big companies do go out of business. Like I'm gonna bet, I don't know this for a fact, but I'm gonna bet that Spirit Airlines somewhere in its comp package had a deferred comp plan, and I'm gonna bet there's some executives at Spirit Airlines who just lost their entire deferred comp plan because they have gone out of business. So like there are real cases where thriving businesses today can be losers tomorrow, and that is a risk that people take on. So I think deferred comp is, again, a very powerful tax planning tool, but I wouldn't want to have my money in it for 30, 40, 50 years because the risk of that time horizon is pretty substantial.
Right. Makes sense to me. And yeah, no, I think the business 401k stuff is probably its own topic for a separate. I feel like we can really get into the weeds there. Is there anything from a high level you wanted to add there?
Yeah, if it's just me, myself, and I, you want to do a solo 401k. If you hire your first employee, but you don't want to offer a retirement plan yet, you might switch over to a SEP IRA for yourself for a year or two. And then when it's time to do a plan for all your employees, you have the option of simple IRAs, which are sort of baby's first 401k in a lot of ways. Just because of the administrative hassle, I often recommend skipping over those and just going to 401ks because you'll save money in hard dollar costs and you'll spend that money in time, energy, effort costs. So, if your cash flow is constrained, you're a nonprofit, simple IRAs make sense. But otherwise, if you can afford it, I really just recommend a 401k at that point. And then all the way along the end of the distribution, you get into like whether you want to set up pension plans or defined benefit plans or something like that. But as you said, that really could be its own entire podcast. That's a pretty complex area.
Very neat. So now your working years, maybe right in the later stages of life. I think at this point, it's not there's not as many accounts. It might be a little bit more strategy driven. But I guess at this point in time, are people still saving, or how are we approaching tax advantages once there is no income to actually put into accounts anymore, which seems to be a big deal for actually having eligible contributions.
I think it's where you find yourself looking at the distribution of essentially where am I retiring? Am I retiring 59 and a half, post 59 and a half? Do I have money in a plan that lets me take it out early, or am I going to have to rely on 72T to take distributions out of an IRA? Like there's a whole collection of questions that go into that. I think the core question that's going to arise in that discussion is what is my source of income during my early retirement? And do I have the means to take advantage of certain strategies, or am I retiring early in such a way that I just want to start living on my money immediately? I think it's going to have a heavy dictation of what strategies can and can't apply in your case.
Let's use an example for both, right? Let's say you're retiring early. Is there anything available, or for you, is it really just about recognizing income in the most tax efficient manner if you're retiring early?
Let's say you retired early in some way, shape, or form, and let's assume you've got, we'll make up a number here. Let's say you've got $250,000 in your checking and savings and whatnot. That's a scenario in which we might say, okay, let's go ahead and start our some of our advantage strategies. So for example, we can do Roth conversions and move money from pre-tax accounts into Roth accounts and reduce our lifetime tax liabilities. We can take a look at something like living on long-term capital gains dollars as long as they're available from our non-retirement accounts, and potentially if our income is low enough where we can keep our income low enough, effectively have a 0% tax rate. There's a couple of early retirement things that come into this if we've got the cash to live on or if we've got the capital gains money to work with, and whether that will then save us enough money short term in tax terms versus using things like Roth conversion strategies and eating the taxes early on and then having 10, 20, 30 years to recover the early tax loss. Assuming that we have that, all that can make sense. If we're in a situation where we don't really have liquid capital available that's not tax advantaged, then we're going to be pretty well constrained to just be cognizant of the division between pre-tax money we use to live on and Roth money. So for example, you're going to blow through the 10% tax bracket pretty easily. The 12% tax bracket, if you're a married couple, is going to get you kind of up to your 80,000-ish level. And there's a world here where you say, okay, I might use pre-tax money for my 10% tax bracket. I might use pre-tax money for my 12% tax bracket. But when I get to the 22, I'm going to switch to taking Roth distributions to go ahead and reduce my costs. Or I'll even switch to long term capital gains because even though I'm not getting the 0% tax bracket, 15 is still lower than 22. So there's some kind of tax arbitrage we play in the lower tax brackets. Most retirees that we see, most people we work with are living in the 22 or 24% tax brackets by default in retirement between social security, pension income, size of portfolios, et cetera. For them, it's much more about long-term planning because there's not a lot we can do in the short term that's going to help or harm them because the 22 and 24% brackets are so wide to begin with.
So if someone's got liquid capital and they're retiring before 65, as you mentioned, it sounds like there are some unique planning opportunities just to recognize income. How is that different than a traditional retirement? It sounds like you're kind of making the assumption like there's other already like just income sources coming in, whether it's Social Security or there's just not as long of a runway to employ some of these strategies, or how does it change in a traditional retirement sense?
Well, I mean, you highlight the term pre-65. I'll give you a good case study example here. We had clients who essentially retired in their mid-50s, and this goes back about 5 or 6 years, and they retired with something like $700,000 in IRAs and about $350,000 in non-qualified accounts and like 20,000 in Roths, and essentially just like a cash balance of checking and savings, nothing substantial. We were able to get them from like 55 past 60 over the last 5 or 6 years, paying an effective tax rate of about 1 to 2% because we utilized long term capital gains for most of their income. But also, in doing so, we were able to put them in a position where they essentially qualified for Medicaid the entire time. So, one of the big concerns or questions we get from a lot of early retirees is how much is healthcare going to cost me? And it turns out the answer for a lot of people is quite a bit. It's not unusual to see couples paying $15,000, $20,000 a year for health insurance in their late 50s or their early 60s. So strategies like keeping your income low enough, through the structuring of assets, through the asset location, can be advantageous from a tax standpoint, but also from a social benefit standpoint, where again, if we can keep our taxable income and these areas low enough under state thresholds, we might either get free healthcare or we might get heavily subsidized ACA healthcare where we've built up an HSA, we've got 30, 40, $50,000 there, and we'll do an ACA silver plan fully subsidized by the federal government and essentially pay nothing for healthcare and still be living on 40, 50, 60, $70,000 of post-tax money where we're enjoying $5, $6,000 a month without really it costing us anything to do so.
Yeah, it's a pretty sweet example. I think I always like telling people as a client with the effective tax rate less than 5%.
Yeah, I'd like to have that tax rate.
All right. So what else? I know there's some things about when people have charitable inclinations later in life, we might have some tax advantages and maybe some gifting strategies later in life. Is that really the extent of it when we're not working anymore?
I mean, there's again the ability to sort of transfer wealth either through the family or through charities. For example, when we get to our required minimum distributions, which our eligibility for this strategy starts earlier. It starts at 70 and a half. RMDs today kick in at 73. Soon they'll be kicking in at 75. But you have the ability past 70 and a half to do a qualified charitable distribution. We can satisfy our required minimum distributions by just giving it away to charity. We can start gifting money to family members. We can try to shift money away from ourselves. And I will say that as a financial planner is one of the funniest things to me is we encourage our clients to save and save and save and invest and invest and invest. And then we often find ourselves advising clients on how to give their money away in retirement for tax purposes, which is just sort of fascinating.
It's funny, the message worked, people live below their means and save a lot, and then by the time they get to retirement, it seems like it's equally as hard, if not harder, for them to actually start spending it a little bit more.
We also have clients who are good at not spending money and not like in a stingy way, but I mean, just like we have plenty of clients who essentially are just living on their social security. They'll have $1 million saved and they'll never ask us for any of it.
Gives me a good framework, I think, especially during those working years for how to start prioritizing some of this. That's really all I had in terms of questions or thoughts on the accounts and the strategies there.
I think the only thing, and we're not going to have enough time here to really delve into it in a serious way, but I think one of the biggest things that happens is if somebody's been financially successful enough, to retire early or get into retirement with, several $1 million, often a lot of the framing shifts from a how do I optimize my taxes or increase my wealth to a how do I protect it. I think there's another conversation we could have sometime in the future about estate planning strategies, trust strategies, different things that can protect your non-retirement assets more effectively in retirement. Because again, you have really strong protections for IRAs, for 401ks, those sorts of things. But I think both in your generation and when passing wealth down to your heirs or your children while you're still alive, there's a lot of mechanisms that can really help protect them from lawsuits, from catastrophic losses, and so on, that are probably worth exploring sometime.
Throw it in the queue.
Daniel, I'll ask, as always, what have you learned in the past couple weeks that you thought is beneficial or worth knowing for our audience?
I thought you threw a fun fact out in a meeting last week about the fact that obituaries were in part created so that your creditors had a way to actually know that you had passed, and there are certain debts that they can no longer come after given that you are not alive anymore. I always thought it was just a way to tell people in the town you've passed, almost just a way to say goodbye, but it sounds like there was a little bit more of a financial element behind it too.
It's a historic anachronism that's been around long enough that it serves both purposes, right? It's still used to say like, oh, Mr. Thompson passed away, how sad, or to share with the community that they passed away. But there was also a very practical estate reason, which was putting your creditors on notice that the clock is ticking to make your claims if applicable or otherwise. You can't have somebody owe you money and then try to go after their family, 12 years after they've passed to say, oh, by the way, they owed me money. Like there's just a reasonable limitation here where, when you notify the public that this person has died, the clock is ticking for people to make a claim if there was ever money owed or something like that.
It sounds like if a loved one's passed, make sure you actually put it in the obituary in a timely manner.
Yeah, I mean it's a thing some people skip because like, oh, I don't know, who cares. And I think in the internet era, there's a lot more stuff to both protect creditors and also to that families can rely upon. But nothing beats just going ahead and doing it the old-fashioned way. There,
Cool. Good chat. Thanks, Dan.
always a pleasure. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.